Hello and welcome to the 300th episode of Investors Hangout. This weekly interaction is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, without much ado, over to our CEO Dhirendra Kumar for a masterclass on wealth creation with mutual funds.
Thank you for being here, and I will just set the context. What are we going to talk about? How mutual funds come into play, and why it is not critical. It is inevitable. If you don't do it, you are losing time, and I'll not scare you. All of you are relatively young. So let me just list you 4 or 5 things which does not come very intuitively to us. We don't really think of money in that context. One is that the most dangerous myth is that playing it safe will take care of it. Because in all other dimensions of life, playing it safe takes care of it. That is why in money issues as well, playing it safe, that you work hard, you earn, you spend, and whatever you save, leave it in the bank, and it is safe, it's taken care of. This is actually a very dangerous myth. This is a myth because this is a recipe for remaining poor all your times, because you work hard, your money also needs to work hard. Second is that the moment you try and get venturesome about your money, then all the roads to enhancing return on your investment is filled with all kind of landmines. Everybody is an interested party. Everybody would like to take him in your direction, and you get scared sometimes. Sometimes you get greedy. Sometimes the person who is actually after you, persuading you to do something, happens to be your friend, happens to be your relative. You implicitly trust him. So that's another thing. So you have to make your money work hard, and that is what we are here for. Setting the premise that why you need to be thoughtful about the money that you'll earn, save, and why it is and it is not a matter of choice. Why it is compulsory. Why you can't do without it. Most of the time, by remaining safe, you are basically losing the opportunity of, you are losing on time. And for your investments to be productive and be rewarding, time is the most crucial thing. You need time on hand for it to really work for you harder. And the magic of compounding actually gets triggered. And the earlier you start, so many a times, many youngsters who start, who should start, but they don't, simply because it's very natural for you to not start. When you start your job, first time you get a experience of being financially independent. You are at liberty and freedom to spend that money the way you want to. And understandably at this age, when you are getting started, you will have 100 needs and limited resources. The initial phase is critical. Initial phase is critical not because you will build, you will have sizable money and you will have time. The first year of your earning is the habit formation thing. If you start with your 500 rupees, because the magic of 500 rupees is not that it will become a sizable thing. It is that you will have 6,000 rupees at the end of year that you have accumulated. And if it has grown, you will understand that the money has worked for free. So far you haven't got any money for free. And this is where the magic happens. From a small amount contribution, turning it into a capital. And so whether it is 500 becoming 6,000 or 1,000 rupee becoming 12,000, depending on, your comfort, but it is more a habit formation and get going with that. You people haven't experienced inflation in the context, but you would have heard stories. Any of you got a sense that your father told you that हम जब छोटे थे तो दूध इतने रुपए का था और घी इतने रुपए किलो मिलता था? That's inflation. Some of the big ticket thing that we do in our lives, that has gone out of hand. And for you to be really on top of things, you have to understand that what inflation is. So why it is critical to make your money work harder, because otherwise you will earn, you will save, keep it in the locker or leave it in the savings bank account, and the money apparently will look as if it has remained constant or it is growing a little bit, but it is actually going down in value. it is actually the most dangerous thing that is happening. We feel that compounding is magic, but the reverse of that is the inflation, and that is something which is devastating for most people. Just earning, saving and keeping it aside is not good enough. You need to invest in equity. You need to invest in equity for the long run. Why equities do well or beat inflation over the long run? Simply because when you buy a share, you are buying the ownership of a company, and any investment that you make translates into either you own things or you are lending money. When you own things, you are entitled to all the benefits that ownership will get you. When you own something, when you own the company, you are entitled for all the future cash flows of the company. A part of that cash flow comes to you in the form of a dividend. What typically happens is, whether you invest in stocks or whether you invest in a stock fund, the promise is that it is likely to beat inflation. And why it is likely to beat inflation, or why they generally beat inflation? Simply because there are the companies which function, whether any company produces some goods or a service. For a company to survive and more so thrive, it must be an economically viable activity. It must be able to do things, because all the inputs to a company providing any service or goods or manufacturing goods must be inflation adjusted. Think of a Maruti car. In 1984, this company was launched and it started producing car. And this car used to cost 45,000 rupees, Maruti 800, the long bonnet one. And over a period of time, that same Maruti 800, maybe it has transformed into Maruti Alto. And now maybe it costs about 3.5–4 lakh rupees. But 3.5–4 lakh rupees from 84 to 2004, how many years? 40 years. If you look at this inflation adjusted price from 45,000 to 3.5 lakh or 4 lakh, I don't know the exact price. But this is something where I would say that this Maruti 800, the cost has come down by nearly a third or maybe half if you adjust it for inflation. And which means that they are able to deliver you a superior product at a lower price, adjusted for inflation. And because companies have to survive adjusted for inflation, because wages will go up, input costs will go up, steel prices will go up, the rentals and the electricity bill and all the inputs that goes into manufacturing or providing a service will go up, and for it to be viable, it must be doing it in an economically viable way, which means that it must be inflation adjusted. And if it is able to make profits and increase prices in line with the inflation, so you being an owner of it, this is the only promise, this is the only hope for your investment, because equity is necessary if you want to beat inflation. And the problem is that equity happens to be a very volatile asset. Equity happens to be very volatile asset because equity tends to do well, but in between it is very volatile simply because there are a lot of factors which affects equity's outlook or equity performance or movement in the equity market in the short run. The only way you can protect yourself is by having a long-term frame, because if you are putting your short-term money, something which is important in the short run, you will be needing it. That is the money which you can't put it. So aligning this, understanding, appreciating. So then comes, the theoretical thing which you keep listening is asset allocation. Asset allocation is something where you diversify your money across multiple assets. You buy stocks, you buy bonds, or you buy a stock fund, or you buy a bond fund, and you also buy some alternative asset, or many a times people think that real estate is another dimension to the investment. Asset allocation is crucial, but not at your stage. For the first 3–4 years, don't worry about asset allocation. But beyond that, once you have accumulated something meaningful as a result of your disciplined savings and putting it to work, is that you need to allocate so that you are able to get some insurance against the sudden surge and decline in the market. And that is what gives you a very different kind of stability. Initially, you don't need to worry because you have not much to lose. So now I have set the context that what you need to do, what you don't need to do, and now I am coming to Why mutual fund for wealth creation? Why mutual fund for wealth creation? Simple. You can do a 500 rupee recurring deposit. As I told you that it's a very risky asset if you are investing for the short run, and it takes great deal of effort to earn money. If you don't diversify, it can go down. With small amount of money, putting it to work, and this is where mutual fund comes into play. What I suggest is that most of you, because you are young, you have the time on your side, the joy of investing in equity is big fun. Maybe do a little bit of that, but make sure that a good part of your investment you are investing in a diversified vehicle. That is the deal. That is the game with the mutual fund. Instead of buying a stock which can go up and down, a company which can die. One more thing I would like to add, which will not be, you people don't worry much about it right now, but you will have to worry about it. As the saying goes that, death and taxes are inevitable. If you hold a mutual fund, the fund manager might be buying and selling every day, and it doesn't matter. You are not liable to pay taxes till you sell it. So if you hold it for 20 years, you are not liable for any taxes. Only when you sell it, and if you sell it after you retire, you will have no other income. That will be the only gain. Maybe you fall in a no tax bracket. So you can plan things much better and so there could be a great value in choosing a fund which you can hold it for a lifetime, because it will be completely tax sheltered till you realize it, till you sell it. Review and rebalance your portfolio. This is where value research will come into play, and set up your portfolio on value research online, and once you set it up, it will be able to alert you the poor investment that you have made, the great investment that you hold, and you will be able to clean up, reorganize, and this is a continuous process. Keep doing it every year. Don't do it every now and then, because doing it too often, you will create a large tax bill for yourselves. Make sure that you are investing diligently and in a disciplined manner. Any money that you need to spend in the foreseeable future, in 1 year, 2 years, 3 years time, just plan some liquidity. Don't depend on the market. That's all that is needed. And rest of the time, money you keep accumulating. You do your SIP, and when you retire, take the money out from your investments, and you will get a tax sheltered income for yourself, for which you will not have to depend on anyone. Accumulating and deaccumulating, which is compounding at a higher rate, is the simplest formula, and don't complicate it. If at all you complicate it, if at all you get greedy in between, if at all you get greedy because you think that you have got that excellent idea, make sure that you are really validating that proof of concept and then getting at it, so that it does not derail your overall plan. It does not really put the apple cart at risk for your financial independence. So wish you very best.
I am an young investor. I start at a very early. I have student loans to pay off. So I want to balance. How should I balance my debt and same time investment?
Look at your student loan repayment as an expense, and invest as much as you can beyond that. And if you are unable to, think of it like it is an investment in your own future, which has been done, and you are repaying the debt.
Sir, I want to ask, when am I ready for stock market, for investing in stock market? And if I think that right now I am, should I sell 60% of my mutual fund and invest that in stock market to gain more? Should I do that?
It entirely depends. Nobody can tell you when you are ready for the stock market, and you will also not know when you are ready for the stock market. It is how you behave when you are faced with a big decline. It will be tested that whether you are prepared for a stock market, because stock market, preparedness for the stock market is not tested in good times. It is always tested in the extreme times, with your patience, with your diligence, with your understanding. And I think it is not a matter of 60%, 10%, 5%. I would say that just the prudent thing to my understanding will be that if you first develop a framework of what will you invest in, how will you invest, why will you invest, and are you going to invest for the very, very long term? Are you going to buy and hold it for many years? If that is the strategy, Then you decide that okay, 25% of your money and let it run for 1 or 2 years. In 2-3 years, you will get an understanding of how your 25% money has done as compared to your mutual fund, and you will have the winner, and then you can actually decide. So, be very objective about it, and in between, but I would say that don't give up on your stock investing aspiration, because it is a worthwhile thing. If you have the time, if you have the inclination, and if you have the temperament, because more than effort or more than financial analysis, more than the foresight to spot a company, it is your own discipline and the temperament which is very material to succeed with stock investments.
हाय सर, मुझे ये पूछना था कि एज अ सैलरीड पर्सन आई हैव 2-3 और मे बी 4 लॉन्ग टर्म गोल्स. सो शुड आई डू एन SIP फॉर एवरी गोल, or maybe should I take some other approach?
You don't need to do 4 SIPs for your goal. If you are able to spot one good fund for those goals, that is good enough. Make sure that that money is good enough for some of those goals. There could be a goal which you need the money for after 5 years. There could be a goal for which you need the money after 25 years. They can all be in couple of funds, because basically you have to earmark enough money, or you have to save enough money so that at certain periodicity you will have accumulation. You don't necessarily need to have separate funds, but if you keep separate funds, there is actually a mental alignment with many of these things. Mentally we tend to, you can actually have different folios in the same fund of different amount.
So my question is, like, for example, I am investing for from the age of 25. So at what time we should pause or stop investing, or just wait for a while?
You should never pause investing. You should take out money when you need money. You should take your money out and invest in something else if it is not doing well. These are the only reasons, because what do you do with the money if you take out? Taking out money just because it has gone up may not be a very wise thing, and it is not a wise thing. You should actually, that is what the whole master class was about, that do your asset allocation, de-risk yourself once it has become meaningful, and take out money when you need money, take out money when your investments are not as good as you expected them to be, and basically that is not taking money out, that is making a change in your investment.
My question is more really a psychology related question. So if we invest at a younger age, it's not considered very cool among youngsters. So it actually seems to be living like a conservative person morally. How can we handle this thing?
Don't tell your friends that you are saving.
Hi sir, I've heard a lot about you. Finally got a chance to meet you in person. So I just wanted to ask, what will be the basic tips, what will be the basic advice you will give to someone who just starts investing?
Don't think, just start, do nothing else, and don't ask me, don't ask your neighbor, do nothing. Just do your KYC and start doing it. There is nothing in investing which can be learned from others. You have to experience it, because you earn your money, and everybody's context is different. You cannot really learn from anyone else, including losses. You have to lose your own money to actually formulate the plan that what happens. So just start, find a fund where you can do a 500 rupee SIP and do it.
I have a generalized question. With this generation, we try to go with the trend, but sometimes we forget to make a balance or to consider the liquidity as well. So it's important to have a emergency funds and another corpus towards the goals, but considering the taxation as well, so we tend to go for tax benefit funds, that is ELSS. But how to keep a balance maintaining the liquidity for the short term goals? What would you suggest?
I would suggest that your short term goals, and short term goals meaning the money that you are likely to need in 1 year's time and the money that you are likely to need in 3 years' time. It should be invested extremely conservatively. In fact, my suggestion will be that even if you are not investing in a mutual fund, if you keep that money in a bank account, the money that you need in the next 1 year, it will still earn 3.5%. And if you put money in a very successful short-term debt fund, it will earn you maybe 6.5%, 7%. And if you are very uncomfortable with choosing one, might be, because for that emergency fund, the money which will be a constant and it will be a defined amount, and you definitely need that money after 1 year, it is not going to make hell of a difference. On 1 lakh rupees, you will earn 3.5%, 3,500 rupee, instead of that 6,500 rupee, which is not a make or break thing. But for your long-term investments, not investing in equity and earning 6-7% or 8% and not earning that 15-16% over a long period of time is a huge deprivation. And today I would say that people should not worry about emergencies. People definitely should worry about their short-term goals and invest accordingly.
So my question is, how should I choose a fund for my future? Like I need good return. So usually how I choose is I see last how it perform for last 1 year or 3 year. But like right now I'm invested in 5 mutual fund, from which 3 are doing good but 2 are not doing good. So I changed it to two new funds, and they are also not doing good. So I'm now confused कि कैसे मैं check करूँ कि which is good or not.
कितने दिन से invest कर रहे हो?
It's been 1 year.
1 year. And in between you started and you closed and then you started again in another bunch of fund.
Yeah.
I will give you a method of how I go about choosing a fund, and I will also make one suggestion to you that don't look at it very often when you are getting started. जब एक बार invest करो तो साल भर के लिए करो और उसके पहले देखो भी मत, क्योंकि बार बार देखने से ना ये बिल्कुल जैसे if you plant a tree, you plant a tree and sapling and you रोज खोद के देख रहे हो कि बढ़ा है कि नहीं बढ़ा है, तो बढ़ेगा ही नहीं और वही हो रहा है तुम्हारे साथ. तो don't do that. But I will tell you how I go about choosing a fund which tentatively I will end up owning for a couple of years. My starting point is I will choose a diversified fund, because I have been telling you all this while that diversify, and that's one of the key benefit. And there are 5 categories of fund which are diversified. One is that large and mid cap fund, multi cap fund, flexi cap fund, value fund, and the tax saving fund. I will choose, I will go to Value Research Online and choose these 5 categories. Then what I will do is, our rating is a scale of risk adjusted performance. A fund which actually, what is a good fund? A fund is a good fund, a good equity fund is the one which rises well when the market goes up, and the one which falls little less when the market falls down. And that is how over a period of time you make little more money than the market and you fall little less than the market, and that is how you generate higher return. And if you invest in an index fund, you get exactly as much, no more, no less, just the expense bit comes down. So our risk adjusted rating is basically a reflection of this. A rating tries to capture a fund which falls less or a fund which rises well. So my universe will be 5-star and 4-star fund of these 5 categories. These are funds which I can hold for a long time. Why I will not hold a sectoral fund or a thematic fund or a small cap fund or a mid cap fund? Because there are times when these funds do extraordinarily well, and there are times when these funds also do very poorly. By having a diversification, these funds, you are actually buying the full market, or the fund manager has the flexibility of investing all over, which has the highest potential, and that is why I will do that. Once I do that, so I will end up with still I will end up with about 15-20 funds. Then what I will do is I will choose a fund which has 7-8 years of life. That will also drop some of the funds, because there will be many funds with 3-year, 5-year history which will figure out. Why I will do that? Because then I will have 2 things to look at. After that, choosing a universe of 5-star and 4-star fund, a fund manager who has remained there, because he was the fund manager of a fund, and I have chosen a fund based on the rating, but he is no longer the fund manager of that fund, so he is gone. I will not be able to attribute that performance to him. So that's one. Second is, I will look at the fund who has done the best in the falling market as well as the rising market in this universe as well. And here I will go with long term return, 5 year, 7 year, 8, 10 year returns, and how it did in the good bad times and the good times, and I will choose 1 or 2 fund and not look at it for full 1 year.
जो पैसिव फंड्स होते हैं, आर दे ऑल्सो गुड, और लाइक एक्टिव फंड्स पे ही हमें इन्वेस्ट करना चाहिए?
If you are meeting me, you should choose an active fund, because I explained you how you should go about choosing one. But if you can't do it, invest in a passive fund, because they will get you 80% of the benefits of investing in equity. There is a possibility that some of these active funds will not do well in some time period. In some time period, they will do better, and we don't know which these times will be. Our effort is that we should be able to spot a company, a fund, which will do well, better than the index over 5, 7, and that is why we are looking at risk adjusted performance, a fund which has done well in a falling market, a fund which has done well in a rising market, and that is what it will translate into its ability to beat the index. But if you are unable to find one, choose an index fund. You will get as much as the index, no more, no less. And when choosing an index fund, you have very simple thing to look at. Just look at the expense. The lower the expense, the better the performance, or the closest the performance.
I want to ask you that while investing for mid-term and long-term goals, what should be the plans and strategies that I should know about the tax strategies and investment strategies?
You should do nothing. Just for your medium-term goal, long-term goal, choose a fund, keep investing, and when you need the money, start pulling out 6 months, 1 year, 2 year, depending on how long you have invested from that investment. And in between, if that investment turns bad, not so good as expected, or as good as when you actually started investing. You started investing based on what I was saying, that a 5-star fund, 4-star fund which is doing well, but after you start investing, maybe for 1 year it was doing well and after that it stopped doing well. Maybe look at the reason, look at the 1 or 2 line which value research analyst will put alongside that fund, and if the rating has slipped dramatically, I really worry about a fund which slips from 3-star to 1-star, I take my money out.
Sir, during this family gathering, there is this general question that comes up, like, whom should you trust with your money? And like seeing so many platforms and the bank RMs even pushing to invest with them. So what is that one advice that you can give us, like whom should we actually trust with our money for financial advice?
The best thing is to learn a little bit, and second best is that keep looking. Financial advice as a profession has not evolved. There are different ways you can do it directly, you can invest on your own, and that is also a nice way of because for your 5,000 rupee, 500 rupee, 10,000 rupees, nobody will be interested in serving, because to provide advice, one need to really understand your context. One really need to understand your temperament, your goals. Nobody will have the time and inclination, because it will not be an economically viable activity for him, for your 5,000, 10,000 rupees. Once it becomes something meaningful, then it will be of interest to everyone. Then bank relationship managers will get after your life, because they can look at your bank account and actually be interested in serving you, because they can earn commission. That is the time when you should, and if at all you don't have the temperament, and if you don't have the understanding, then ask some question. Where is he from? Is he interested in knowing so much about you? Is he a product pusher? Because these are questions. It is almost like hiring a person. You have to interview him and to understand how he will serve you. And it's a very dicey profession, because many of the advisors, they come with they pretend to be advisor, but they are basically selling and they are investment salesmen.
So, sir, a few weeks back, I was talking to a friend, and he told me that he switched to passive investing altogether. And I asked him why, and he said that the fund he was invested in, the fund manager changed. He exited the fund, and the fund deteriorated. The performance went down. So my question is, when researching for when investing in a fund, how important is the fund manager's background or qualification is, and If the fund manager changes, then should you like revisit that decision?
The fund manager is the most important person or variable in the whole fund performance. And if the fund manager changes, you should get alerted. You should be worried about it. But many a times, the fund manager change is for the better. Sometimes the fund manager change is for the worse. So figure out. I will give you an example. Recently a fund was launched, and normally at Value Research, our whole hypothesis is that never invest in a fund without a track record. But here was a fund manager who came with a track record of 30 years of excellent performance. He managed some fund 30 years back, and he managed it for 10-15 years. He did so well that when we look at his long-term performance even now, because of those periods, it actually stacks up at the top. I was very excited and tempted to invest, and it has actually turned out to be true. But at the same time, take note of one thing, which many young people getting started, great fund managers have lean period. And not so good fund managers also turn good. The real thing is that if you can look at 10-year, 15-year, 20-year period, over these periods, look at how many funds have been able to beat the benchmark. The whole talk that we get, I'm saying that investing in index fund may not be a bad idea, but if you are really wanting to beat the index and spending little effort in looking at alternatives, it might be worthwhile, and it can be done.
In today's digital age, many influencers are promoting investing through SIPs or stocks, while our parents still recommend investing in real estate, gold, etc. Today, younger generation are going for IPOs, stock trading, etc. So what do you suggest, which is the right investment path? And if you are referring to, let's say, mutual fund and stocks, then is it really possible to buy a house at the same time and do a SIP and stock investments?
For youngsters, any of these things is a good thing. I'm not very averse to people trying out things, because the biggest learning comes from doing things, not by listening to masterclass. This could be helpful, but I'm not expecting that you will listen to me and you will start following it tomorrow, because we all will have aspirations, we all will have different contexts, we all will have a very different importance of money that we are earning. But I would like most people in initial 1 year, 2 year, 3 year, dabble in stock, do some trading, do some speculation, buy some crypto, lose that money, or do all this, because these are all part of learning. But don't let any of the learning go waste. And in the process, develop a framework. And I think at Value Research, in our magazines and everything, we try and give people framework rather than a prescription. Because if you are able to develop a framework that when you should buy a house, my framework for buying a house is that if you are going to live in that house, by all means buy it. If you are going to invest in a house expecting that the price will go up, never buy that house. Never buy that house for a simple reason. It's a very big ticket purchase. It is not liquid. And when you go to buy a house from an investment point of view, the fellows who are actually selling that house, they will tell you that this is the last piece. And when you go to sell yourself, you will find that there are no buyers. So you will not be able to sell. It is a very illiquid thing. It is a very high, big ticket size thing. And you will borrow for such a long period, such a large amount of money. You will end up with a liability without a meaningful asset. That is also a possibility. But if you are going to live in that house, that might be worthwhile. And you will have the pleasure of owning a house. Then how much money should you borrow for buying that house? That is another question. When it comes to a house, people get very emotional. Be little realistic about it. Make sure that 30% or 35% of your income is not going towards your EMI, which means you have to actually scale down your house purchase, the value of the house that you're buying. Second is that you are able to wait for it, so that you are able to accumulate your down payment to the extent that only that much money you are borrowing, which can be supported by 35% of your income. And the third thing is that ensuring that you are going to start living in that house, so that you start saving on the house rent immediately. If these three things fall in place, this is the framework.
So, sir, you have talked about asset allocation during the session many times. So, when we invest in like multi-cap funds or flexi-cap funds, the fund manager takes care of everything like diversification, allocation, etc. But when we are investing in stocks directly, so how to decide the allocation between large cap, mid cap, and small cap? So, is there any formula or something like this?
No, when investing in stocks, no, don't look for formula. Look for a good company, and look for a good company which remains good. And keep looking at it time and again so that whenever it turns bad, you are able to sell it. Don't bother about large cap, mid cap, small cap. There could be a great small cap company and there could be a great large cap company. There are small cap companies which die, there are large cap companies which die.
Actually, my question is that there are people who never started investing in stocks, mutual funds. They are way far from the market. And if they want to start at this point of time, should they start investing in mutual funds, let's say, because stocks is not something they should do in short term?
Look, mutual fund is nothing but a bunch of stocks. Just that you buy the bunch of stocks with great convenience, it actually, it has the shock absorber. When you buy a mutual fund, what is it? You are buying 50 stocks. 20 of them will go down, 20 of them will go up, and 10 of them will go nowhere. Any day, equity mutual funds don't go up and down by 5%, 10%. But every day, there are 50 stocks which go up and down by 5%, 10%. This is the difference in diversification. So, if anybody, there are two ways of going about, basically what you are asking is that if somebody has to start now, how should he go about doing it? If it is you who has all of one's life, then start with a small cap fund. Start with an index fund, start with a multi-cap fund, it doesn't matter. Just do it and next 1 year. And don't buy that Nike shoes. That's one. Second is that, if my father's friend or my, वो जो बाहर हमारे यहाँ जो गार्ड साहब बैठे हुए हैं, उनको अगर इन्वेस्ट करना हो, तो मेरा एडवाइस डिफरेंट होगा. मैं उनका ना SIP किसी के साथ बिठा करके उनको अग्रेसिव हाइब्रिड फंड में लगवाऊँगा. क्योंकि तुम्हारा ना 5,000 रुपया लगा हुआ ऊपर नीचे होता रहेगा, तुम्हें कोई खास दिक्कत नहीं होगी और तुम्हें पता भी है. सो यू आर लिटिल इवॉल्व्ड. उनके लिए ना दैट विल एक्चुअली बी एडिशनल शॉक एब्जॉर्बर. वो जब 2-3 साल वो हो जाएगा ना, देन ही विल बी रेडी फॉर अ मल्टी कैप फंड. सो माई एडवाइस टू दीज टू पीपल विल बी डिफरेंट. एंड दिस इज ऑल्सो समथिंग विच वी हैव फैक्टर्ड इन वैल्यू रिसर्च फंड एडवाइजर. When you, depending on your experience, depending on your scale, because 5,000 for you will be very different value. 5,000 for him will be of completely different value, Well,
that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.